Hey guys, in today's video, we'll be going over chapter 1 through 13 of the Builder's Guide to Accounting. If you don't already have your book out, make sure to pull it out. If you have any questions about the highlighting guide, please click the link down below. And I have a whole entire course going over the Builder's Guide to Accounting, Contractor's Manual, AIA documents, so you can pass your business and finance exam on the first try. It also includes practice exams as well, over 10 practice exams, and over 1,000 questions in the question bank for the practice exam. So every time you take a practice exam, it's a different question. If you're also struggling with the math for Builder's Guide to Accounting, there's over a 40-minute video going over all the math you need to know for the Builder's Guide to Accounting. If you guys also want to join the free WhatsApp group, the number right here, text it right there. I'll add you to the group. It's everyone talking about the exam for business and finance. And if you have any questions, you can also message me on that number as well. Also, a freebie for you guys. There is a free practice exam for the Builder's Guide to Accounting. If you use the link down below, put your email and I'll send you a free practice exam so you guys can test how you guys are doing on this specific book, Builder's Guide to Accounting. So yeah, let's get into it. It's chapter 1 through 13, all the highlighting you need to know. So let's go. I didn't have anything on page 1. Is going to be reducing your costs will achieve maximum efficiency is the goal of well-designed bookkeeping system. So the records you need. But if you can make good use of the financial information in your books, you'll be a more informed manager. The more insight you develop, the more effectively you become. The sales journal. The sales journal is a detailed record of all your income from operations. You need this detail for financial statements. It also provides a good way for you to see how you're doing compared to last year, last month, or last week. The comparison of income to past performance is very important to you in planning. Good sales records are also helpful in finding the right market for your services. Because there are so many different kinds of contracting markets, you must know which ones will let you compete most profitably. Okay. Naturally, you need to know who owes you money. Your method of keeping track of receivables is important to the accuracy of your billings, your collections, bad debts, and financial statements. Many builders run into their single largest bookkeeping problem when it comes to keeping track of receivables. So they might ask you on the test, what is a builder's single largest bookkeeping problem? And it's keeping track of receivables right there. The check register is a listing of all checks with expenses broken down into categories. It's important to write up this record each month, or even better, each week. Bank accounts. Also, if you guys have noticed, I am here wearing a wedding band now. I did get married. It's kind of the reason I took a break for so long. So yeah, now I am married. Don't depend on your bank to keep your checkbook straightened out. Balance your bank account every month to be sure how much cash you really have. Once again, balance your bank account every month to be sure how much cash you really have. Cash on hand. Most builders need a cash fund for the little expenses that come up from day to day. COD deliveries, postage due, coffee and donuts, a newspaper, expenses too small to write out a check for. Setting up a controlled petty cash fund is the best way to control these disbursements. In a petty cash system, you vouch for all expenses by replacing cash removed with a slip of paper, a voucher. That explains the reason for the expenses or list an account number and gives the amount. Your records should let you calculate the hourly cost of owning and operating your equipment. That's equipment records right here. Okay, overhead expenses. The fixed necessary expenses of being in business are often considered to be uncontrollable. Your record of past overhead expense is the best indication of what you can expect in the future. If they ask you your overhead expense, how do you indicate your overhead expense? Your record of past overhead expenses is the best indication of what you can expect in the future. So it's your past record of your overhead expenses. A good budget for overhead expenses will serve as an important guideline for month-to-month planning. Accruals. Accruals is very important. You need to know what accruals is. In the course, I go more in depth in what accruals are and explain what it means better. So if you need help on this, once again, join the course. Bills you've sent out are income, even before the cash comes in. And the bills you owe are direct cost or operating expenses, even before you mail the checks. These are called accruals. The chart of accounts. is a numbered list of the accounts on your general ledger and operating statement. Ratio. These ratios show month-to-month trend of your business. These trends are useful in revealing financial statements themselves. For instance, a statement that compares this year's performance to last year is valuable for finding out whether your management skills are producing profits and whether your financial health is improving or declining. Okay, double entry bookkeeping. Very, 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 very important. The most common modern bookkeeping method is called double entry bookkeeping. This is, I think, a question everyone gets on the test. They'll ask you, what is the most common modern bookkeeping method? And it's double entry bookkeeping. This is something I go over in the course showing you, hey, this is most likely going to be on the test. I try to go in the course giving you all the information as fast as possible so you don't have to watch thousands of videos. It's just like, here you go. Here's all the information. This is all you need to go pass the test. Double entry bookkeeping is so called because every transaction requires 2 entries. Once again, double entry bookkeeping is so called because every transaction requires 2 entries. A debit is an entry made to the left side of an account, and a credit is an entry made to the right side account. This is very important, understanding what debit and credits are. Debit balance pluses and credit balances minuses. Very important. I go over this as well in the course so you can understand this. That is very important as well. It's kind of a cheat sheet. All right, the debit increases in expense count and decreases the balance of cash. All entries to the general ledger, the record that summarizes all business operations. Figure 1.1 shows the traditional ledger page. Debits are posted on the left side and credits on the right side. Figure 1.2 shows the results of posting to a single general ledger account from several sources. The T account, so named because of the letter T, created by lines, is used here to demonstrate this. The T account is a simple way of separating debits and credits on a worksheet. The financial statements are reports which express information summarized from the general ledger. The balance sheet is one of 3 financial statements. It's a listing of properties, assets, debits, and liabilities, and ownership value, net worth. The term balance refers to, and right here, very, very important ratio. I go over this in the course as well. You got to know this ratio. And also there's different ways this ratio is written that they don't show in the book that you need to know as well. The income statement. List of income, directs, costs, operating expenses, and profits. While the balance sheet lists the balance in assets, liabilities, and net worth accounts as of a specific date, the income statement reports the results of operations within a defined period. All right, the statements of cash flows. Last year's income paired to this year's will reveal the good and bad trends in the business and the increase of decrease in volume, expenses, and profits. Okay, let's get into chapter 2, accounting methods. So the way you treat sales and recognize the income they generate is the foundation of any accounting system you adopt. The decision about when to book income creates problems for both the builder and the accountant. There are 2 accepted ways to record income: the percentage of completion method and the completed contract method. So that's a really important line right there. If they ask you what are the 2 accepted ways to record income, it's the percentage of completion and the completed contract method. We'll go over percentage of completion and completed contract method in this chapter as well. But contractors sometimes receive payments for work not yet performed or only partially completed. The portion of income above the degree of completion is said to be unearned in the accounting sense. It is not earned and should not be recorded as income until the work is completed. When you receive cash for work that's only partially complete, you have to separate out the unearned part of income and assign it to a special account. This is known as percentage of completion accounting. So right here's an example of percentage of completion. In the course, I go over this more in depth. Okay. Accountants handle situations like this by deferring the unearned income. Right here is an example as well. The following shows an accrual of unearned income. I go over this in the course as well. Most contractors and builders use the percentage of completion method for recording income. It's the only acceptable method for builders who have fairly large jobs in progress. Under percentage of completion accounting, your books reflect the effect of receiving payment either or after it's earned. Retainage, Retainage serves two purposes. First, they serve to guarantee against unforeseeable problems with final completion of a project. The advantage of percentage of completion. This is important. You have to know the advantage of percentage of completion. Right here is the income and its related costs, expenses, and profits are recognized and reported as the job progress. The term recognized refers to the accounting treatment of an amount. The disadvantage of the percentage of completion, and then read the disadvantages. And then right here is the money ratio. This is a very important ratio right here. Find the current percentage of completion by adding the total cost to date. So in the course, I go over how to use this ratio, and also they'll have questions that you have to figure out how to get the numbers to plug into this ratio. As simple as people make it seem, they're not going to be like, here's the cost to date, here's the estimated remaining cost of completion. They're going to make you work for that. They'll make you do math to actually get the cost to date and estimated remaining cost of completion. That's what I go over in my course. I show you examples of what are questions that they could give you on the test regarding percentage of completion, and I show you how to do the math to get the percentage of completion. Recognizing income by the completed contract accounting method has the advantage of exactness. There is no need to estimate the degree of completion because all income is recognized only when the job is 100% finished. You know what's weird? In the contractor's manual, if you read completed contract method in chapter 3, it says that completed contract method is recognized when you're like 98% complete. And here it says 100%. So there is difference between the contractor manual and the builder's guide to accounting. It's a little weird. This method is almost always used for small jobs, one-time work, material sales, isolated minor contracts, and other job of short duration. You can only use completed contract accounting only when you complete a job within 2 years from a contract date, and only if your annual gross receipts are under 10 million. There are 3 major disadvantages of the completed contract method, and then they go over the 3 right here as well. Okay, moving on. A small builder specializing in residential repair work can use the completed contract method because nearly all work is of short duration, but if the type of work he performed begins to include larger duration jobs, he may have a good reason to adopt the percentage of completion method. Like many contractors, you'll probably want to use the percentage of completion method for long duration contracts and keep shorter jobs on a completed contract basis. Under percentage of completion accounting, all retainages are accrued income. Any prepaid income must be deferred. This is important right here. The unearned income accounts are assets. All right. Figure 2, you might want to read that as well. Okay, moving on. So asset accounts, liability accounts, income accounts. The accrual system is by far the most accurate. As an alternative to the accrual system, you can also keep your books on the cash method. The advantage to cash accounting is its simplicity. All right, and that is it for chapter 2. Okay, let's get into chapter 3, cash and charge sales. Cash sales are payments you receive for work or a product. Charge sales are all sales you made on credit and for which you will issue monthly statements of charges. Receipts are posted in 2 ways. If you're keeping your books on the accrual system, income goes in the books when earned. The debit is made to the assets account called accounts receivable, and the credit is made to income. Later, when your customers makes a payment, the debit goes to cash and the credit, it goes to accounts receivable. Your entries should look like this. It's a good example here. Recording cash sales. List your cash sales by date so you can create summaries for general ledger entries. If you do any work on credit, you have to use an accounting method that records both cash and charge sales. Nothing on there. Okay, this is one of the important things that is in this chapter right here. It says, most builders allow a 2% discount to certain types of trade accounts, only rarely to all customers. 99% chance this will be on your test, so make sure to have that saved. The real value of a good receivables method is in the variety of information it provides. Invoices should show enough detail so your customer can identify the materials and service and pay according to your terms. tracking receivables. If retainages or similar withheld amounts become a major part of your receivables, set up a separate receivables account file for retainages in your general ledger. Okay. Control the collection of accounts receivable with the aging list as in figure 3.9. Builders who are in close contact with their customers may know quite well who owes them money, but an aging list can still provide needed information in written records of slow paying accounts. An aging list indicates what percentage of total receivables, excluding retainers, is current and what percentage is past due. Current is less than 30 days. Make sure to know what current means. It's less than 30 days. Okay, for moderate volume, some business owners like the pegboard system. Okay, verify your figures. This is how you get your current balance. Previous balance plus charge sale minus credits equals current balance. This isn't really that important. I don't think you'll see that on the test. And that's it for chapter 3. If you have any questions, please let me know down below. You can message me on WhatsApp or email me. And if you already signed up for another course and you're not liking the course, please message me. I'll work out a deal with you so you can get into a course that is actually going to help you pass the test. So yeah, thanks so much for watching, and see you guys in the next video. Peace. Okay, let's get into chapter 4, managing receivables. But your past experience is still your best indicator of the future. All right. The most common way to chart your accounts receivable trend is to calculate the number of days the average account is outstanding. An excellent way to keep tab on collection is to prepare an accounts receivable average length study as in figure 4.1. So here are the 3 important ratios you need to know how to do. You need to know how to plug in the numbers and how exactly to use these ratios, and how to know when they're asking for these ratios in a question. I go over this in the course on how to use these ratios, how to plug in the ratios, all examples, and then there's practice quizzes that have these ratios in there so you can give it a shot yourself. So the first ratio is period of average receivables. The second ratio is 12 months charge sales. And the third one is average days for outstanding receivables. Stay on top of existing accounts, but there's another important part of the receivables equation: prior qualification of new charge customers. Figure 4.2 is a credit application. Make it company policy not to extend credit unless there's an application on file. But when you assign an account to a collection agency, list it in a separate column in your accounts receivable analysis and exclude these figures from monthly totals. Okay. And then right here, another important thing, we kind of went over this in chapter 3. It may help to offer incentive discounts such as 2%, 10 days, net 30. That means the customer can deduct 2% from the invoice when payment is sent within 10 days of the billing date. This is a standard arrangement for shops that offer discounts, and it seems to bring payments in quickly. 99% chance this is on the test. In the course, I go over what a question would look like for this on the test and how to do it, how to do the math on it as well, because they're asking you to do math on it. And one thing I mentioned in the course, if they ask you in a question 10 days net 30, that means you need to know exactly what it means. That means the customer can deduct 2% from the invoice when payment is sent within 10 days of the billing date. There you go. That's why you need to know what 10 days net 30 is. I hope you guys liked today's video. Once again, if you want free 20 questions practice quiz for the Builder's Guide to Accounting, there's a link down below to get those free questions. And I will see you guys in the next video. Peace. Chapter 5. Bad debts can be a big profit drain on your business. When an account becomes uncollectible, you must reserve the income you record previously. To do this, you write off an account in both the general ledger and on the customer's account ledger. You could write off the accounts on the sales journal itself, but that's not what most accountants recommend. Generally, you should write off a bad debt only after exhausting all efforts to collect, but the rules change if you receive notification that the customer has filed for bankruptcy. At the point the law provides a procedure for filing a claim for payment. Further efforts at collection may violate federal law. Right here is very important. For tax purposes, bad debts can be recognized only when, read through that, the possibility of collection must be just about non-existent. Right here, Setting up a reserve for bad debts has some important advantages, and then it goes over the advantage here. Read through that, super important. Here are 3 ratios that are super important that I go over the course on how to do them, how to plug in the numbers. Everything you need to know about the ratios I go over in the course. So if you're not in the course yet, link down below, join the course. And then here are the 2 other, delinquent ratio and credit sales ratio. These 2 are very important. 99% chance see these on the test, so make sure you know how to plug in the numbers and use these ratios. And once again, in the course I go over that, link down below. And right here is super important. Delinquent receivables are the amount due more than 30 days. Delinquent receivables are the amount due more than 30 days. Super important. Summaries like the bad debt trends reports are valuable because they support the financial statements required by your bank or bonding company. Read the information in figure 5.3 for January as follows. There was $1 of charge sales for every $1.14 of total sales. In the same month, $1 in accounts receivable was delinquent for every $6.90 of total receivables. We wrote off $1 in every $39 of credit sales. And last thing, the reserve for bad debts accounts is a reduction of your current assets and should appear in the general ledger immediately after the accounts receivable. So that's it for chapter 5. If you have any questions, you can message me on WhatsApp and you can use the link down below. Chapter 6, the only way to find out what jobs are making and losing money is to analyze your sale records by the type of work you do. Analyzing sales records. This is essential for cash budgeting, planning for future available funds. Okay. A high percentage of cash receipts generated from one place could indicate that moving into new areas might be dangerous, or it could mean that the builder is overly dependent on one small part of his total operation to support a large portion of his cash needs. To understand the significance of sales and their varying values and yields on investments you need, and then highlight these as well. Okay, and that's it for chapter 6. We're going to get into chapter 7 in the next video. If you have any questions, please message me. And if you guys want to join the course, link down below. Chapter 7, sales planning. The successful builder seeks profit, not simply volume, when taking on more work or looking for new lines of business. But the quality of your sales volume, not the amount, is the key to higher profits. Low profit volume never adds to growth of an operation. Instead, it saps income, ties up working capital and equipment, and demands time and energy that you could devote to more profitable projects. Analyzing the risk. If your volume remains the same, the commitment of additional time, money, and equipment means that the risk of a large loss grows greater. You should be aware of the increased risk before you commit yourself and your business. You can commit additional assets without increasing your risk if your volume grows proportionally to your assets. The bid, contracts, and materials sales category yield the minimum 5%, but account for 60% of the total volume. Okay, and that is going to be it for chapter 7. If you have any questions, please message me. And if you want to join the course, link down below. Chapter 8, planning for profits. It's wise to consider abandoning any part of your business that does not produce profits. The combined yield of a work A and B is 6.5%. Because work in the C area is losing money, it drags the total yield down to only 3%. Okay, nothing here. The relationship between volume and profit. It's important to understand the relationship between volume and profit. You should recognize this relationship when you decide to concentrate your efforts in one market and abandon another. The margin of profit increases with volume if costs and expenses are declining. Percentage of gross receipts. This is important right here. Make sure to highlight that and underline that. And then without that advantage, the profit margin will remain the same with increased volume or may even decrease. Selling expense usually rise in steps and are related to business volume. And that's it for chapter 8. If you have any questions, please let me know and I will answer them. Okay, now we're going to get into section 2 of the Builder's Guide to Accounting. We're going to go over chapter 9. So if you guys know, the Builder's Guide to Accounting, it is set up as in sections. So you have section 1 is chapter 1 through 8, section 2, 9 through 19, and then section 3, 20 to the appendix and the index. So in my course, I actually break this down into 3 separate sections like they do in the book, so it's easier to understand. So now let's get into section 2, chapter 9, check writing and recording. You can't control your costs and expenses effectively if you don't follow good check writing and recording procedures. Okay, start by writing out complete names and description for each check and carry a balance of payments by account. This will support summary entries recorded elsewhere, aid you in balancing your bank account, give you detail needed for adjustments to accrue or defer costs and expenses, provide records for analysis and forecasting. The check stub and the canceled checks are supported by source documents. Here's the basic information you must record when you write a check regardless of the format of your check system. The check number, the date, who was paid, what the payment was for, or an account number, the amount of the check. Avoid math errors and bringing forward the balance by checking each page backwards for accuracy. From the bottom, add all checks and subtract all deposits. And then adjustments to make, highlight those as well here. The check register shows at a glance what expense categories you have and where your money goes. Prepare the register at least once a month. So they might ask you, how often should you prepare the check register? And it's at least once a month right there. One major function of a check register is that it identifies math errors. This is called cross-footing. Writing checks to cash. Avoid writing checks made out to cash. Business deductions for checks made payable to cash are questionable and harder to prove than checks drawn to specific payee. Okay. This voucher checks. This was popular when a typewriter was the primary office tool. However, voucher checks like pegboard systems are becoming obsolete. Don't think you have to worry about that. The most efficient way to keep track of accounts payable on a monthly basis is to maintain 2 check registers, one for current month billings and another for previous month billings. Pretty important right there. Okay, multiple businesses. The best accounting system for a builder who owns both businesses is to avoid transfers between the 2 operations except for periodic adjustments. Okay, and that's it for chapter 9. Chapter 10, this is a very important chapter. There'll be at least 3 questions on the quiz from this chapter, so I highly recommend paying attention in this highlighting guide. And I go over this chapter in my course. If you're interested in joining my course, link down below. So let's get right into it. Materials include everything you buy that will be installed on your jobs. Freight charges on that material are direct costs because they're a part of the cost of getting the material into the structure. Indirect costs are the expenses of taking a particular job that don't involve any work on the job itself. Indirect costs include freight, administrative, payroll, and small tools, and anything not billed to a specific customer. Overhead is the cost of the items you need to conduct business that you can't charge against a particular job. So understand these 2. That's because about half of your direct costs will be for material, and it's estimated that about 8 to 10% of labor costs on residential construction are spent just to move materials from the curb line to where they're installed. This right here, 99% chance will be on your test. So make sure to know where this is. I go over this in the course. Problems caused by sloppy material control, make sure to know that. Volume buying is a big part of good purchase planning. Controlling purchases. Written purchase orders are the most simple control device. Figure 10.1 shows a typical purchase order. A purchase order form should include the following information. Accounting copy to be matched to the invoice when received. Keep these in alphabetical order until bills are paid. Check the prices on the invoice against purchase ordered agreed prices. Okay. Summarize your purchase orders on a purchase journal so you can analyze total company material purchases at a glance for a given period. Some builders use the purchase journal as a source document for accounting entries, but if your purchasing system requires that you use a purchase journal as an accounting document, here is the entry you must make each month to record purchases. Controlling inventory. Controlling your inventory requires a purchasing plan that's in line with a strict inventory level policy. How much do you need to keep on hand and of what materials? Lack of planning and control can leave you with too much or too little material at any given time. All right, this page is important. 120 to 121. Valuing inventories. You will have this on your test, 99% chance. Inventories are usually valued on some types of cost basis. Since the methods used to report sales, profits, and yields are all based on an actual cost, job estimates are based on cost as well. So it's logical to maintain your inventories the same way. There are 3 cost basis valuation method worth considering. The right one for you depends primarily on the size of your average inventory. Read each one of these. In my course, I go over and explain each one because you need to know. This will for sure be on your test, 99% chance. There are 4 major inventory categories. They should be distinguished from each other since you may have to keep separate records unless all your materials fall into the first category. Read through these categories, understand which one they are. I go over this in my course as well. Analyzing materials and inventory. There are 2 principal ratios. One is the cost of goods sold to average inventories. The other is sales to inventories. The sales to inventories ratio isn't a precise indication of effectiveness because inventories are based on the cost of materials and sales are based on a computed cost plus profit. But you can use this ratio if sales are stable from month to month. Cost of goods sold to average inventories. The cost of goods sold represents all direct costs adjusted for the change in the inventory levels. Here's how to calculate it. Shown below are physical inventories based on the calendar year, but partnerships and corporations can base their physical inventories on the fiscal year. Since there are 4 possible types of inventories, there are 4 variations of ratios. Here's the ratios right here. A low ratio can mean that your average inventory is too high. A high ratio can mean that you're maintaining too small an inventory and may result in lost sales. Good inventory control does the following, and it goes over to page 122 as well. So that's chapter 10, a very important chapter. If you have any questions, you can text me or WhatsApp me. And if you're interested in joining the course, click the link down below. Okay, chapter 11. Labor is the largest and most variable cost in building. And then I have these highlighted right here, those bullet points. 4 ways to keep separate payroll records. Pay a bank or an independent data service center to prepare the payroll and provide backup reports. Issue payroll checks from the one general account and from the same check series. Checks in this account must be designed to handle payroll stub deductions. Use the general account for both payroll and other payments, but use a special style of check with its own numbering system for payroll. Enter payroll on the check register in the summary form. Set up a separate payroll account with its own check style used only for payroll. Nothing there. Nothing there. Accounting for tax liabilities. Okay, figure 1110 shows that a flow of funds through clearing accounts such as payroll taxes withheld on a gross payroll of $5,000. Withholding taxes are $1,521 for the current month. This amount includes the tax liability on behalf of the employees. Okay, this is an important section. This is also inside the contractor's manual as well, so we can go through it real quick. The federal government publishes several forms for payroll taxes. Be familiar with each of them and know how they apply to you. Form W-4 is the employer's withhold allowing certificate. Anytime there's a change in marital status, number of exemptions, or addresses, make sure the employee completes a new W-4. File Form W-2 wage and tax statement every January for each employee. That's important right there. Copy A. To the Social Security Administration, the W-2s for all employees are summarized on Form W-3. Transmittal of income and tax statements. Copy B. To the employee to file with his or her federal income tax return. Copy C. To the employee for his records. Copy D. Kept by the employee for his records. Copy 1. To the state taxing agency summarized on the state version of Form W-3. Copy 2. To the employee to file with his state tax return. Use quarterly and annual forms to report wages and pay taxes. Form 941, employee's quarterly federal tax return. Form 940 is an annual report used to pay federal unemployment taxes. So I want to see if, like, in the contractor's manual, I can't remember if you can look up forms here and it will show you where to go. Let's see. Let me see here. Forms, yeah, it has forms, but it doesn't give you like the specific forms to go to, because if you go, let me pull out my contractor's manual real quick. If you go to the contractor's manual index, it will actually show you. Hopefully you guys can see that. There you go. Let me see if it shows at the under forms. If you go to F, it will show you the exact forms and what page. So like 940, 941, 944. It doesn't do that in the Builder's Guide to Accounting. I like to use, when I give it a form question, the contractor's manual. But you can find it here in the Builder's Guide to Accounting as well. Okay, last thing. Summarized below are the federal tax form most builders need for their payroll accounting. Form W-2, Form W-3, Form W-4, Form 8109, Form 508, Form 940, and Form 941. Some types of payments to include on your 1099 are dividends or interest over $10 in 1 year, and rents, commissions, and other types of miscellaneous income over $600. You pay someone other than your material suppliers. And that's going to be it for Chapter 11. If you guys have any questions, you can message me on WhatsApp, and you're interested in joining the course, the link is down below. Chapter 12, overhead expenses. Overhead expenses tend to remain fairly constant in spite of changes in your sales volume. There's a difference between labor, a direct cost, and union welfare expenses, a variable cost. Okay, this is important right here. This like little chart, this figure 12.1. You will most likely get a question on the test on this. I do go over this in my course with more information, but here they have variable expenses and fixed expenses. So they have variable overhead expenses, and they go over each one right here. And then they have fixed overhead expenses, and they go over each one here as well. This is super important. You should know where this is and how to understand it and everything. So read over this, and if you're interested to join the course where I explain this, link is down below. Goes over more here. Budgeting expenses. The budgeting process has 3 parts: preparing the budget, analyzing the results, taking action to control expenses. Another approach for variables would be to set budgeted amount for expenses based on assumptions about the level of sales or labor. Variable expenses right here again, and fixed expenses here again. Okay, this is kind of important right here. It's showing you the entry to record a prepayment such as insurance. So the prepaid asset, the debit, and then the cash is the credit. And then here it shows the entry to record each month's charge is insurance, the debit, and the prepaid asset, the credit. And this is important here as well. The cost of organizing a business can be high. The cost should not be charged against the first year of operation. Instead, you should set up in an asset account organizational expenses and write off the cost over a period of years. This process of spreading costs over a period of years is called amortization. It's handled like depreciation. You charge an amount to an expense category each month and reduce the assets by the same amounts. They go more over this in the next chapter, in chapter 13 as well, amortization. And that's everything for chapter 12. If you have any questions, you can message me on WhatsApp or text me. The number is right here. And if you guys are interested in joining the course, link down below. I'll see you guys in the next video. Now we're getting into chapter 13, equipment records. The largest single investment that most builders make is for equipment. You list your equipment on your balance sheet at its cost and depreciate it over its estimated life. The act of setting up an asset in the general ledger is called capitalizing. To take expense for a purchase over the life of an asset is to depreciate it. Fixed assets aren't actually fixed, so the term long-term asset is often used. This is more accurate because it describes an asset with a long, useful life. Long-term asset, let's explain what a long-term asset, and then a current asset as well. Current asset is less than 1 year. Long-term asset is over 1 year. Make sure you know that. Okay. The well-organized builder should have a defined plan for fixed assets. Classifying fixed assets. Your balance sheet should show enough details to reveal the true position of your business. And then right here, of what most builders should use to classify their fixed assets: office furniture and equipment, trucks and autos, machinery and equipment, small tools, building improvements, land. This is very important. All long-term assets except land are depreciated. Right there, very important. Unit cost for equipment. This requires certain information about each piece of equipment, estimated average hours of use and idle time. And then it has more over here. This information will help you put together more accurate estimates and analyze project cost. All right, figure 13. 4, under distribution by jobs, record the amount of idle and repair time and useful activity. Depreciation, super important here. Depreciation is designed to let businesses recover the cost of buildings and equipment over the useful life of the property. And then they're going over the Marks Act right here. Very important, read through that. Modified accelerated cost recovery system. You need to know what the Marks is. Okay, how to claim depreciation. There are several ways to claim depreciation. Under Marks rules, you may use a prescribed method or elect to use one of several straight line alternatives. But assets you begin depreciating under the rules can continue under the old method until depreciation or recovery has been completed. Questions you must ask before you begin to depreciate assets. Is the asset depreciable? You can't complain depreciation on land, inventory, or intangible property. Very important. And the Mark system dictates the depreciation periods you're allowed to use for each specific class of asset. The depreciation periods, called recovery periods, specify the time over which you can claim depreciation for that class of asset. We'll go over that. Straight line depreciation is a way to spread the cost of an asset evenly over its useful life. The same amount of depreciation is taken each year until the depreciable base is reduced to zero. This is very, very important. You need to know how to do straight line depreciation. It's one of the most important math problems on the exam. Right here, they're showing an example. I go over this in the course, step by step, how to do straight line depreciation. And also, they will have questions on the test about straight line depreciation that they don't talk about in the book. I go over them in my course so you know everything and you're well prepared for straight line depreciation. Declining balance depreciation. So this I go over in my course as well. You need to know how to do straight line depreciation and also declining balance depreciation. The most important one is straight line depreciation. You can probably pass the exam without learning declining balance depreciation, but we'll go over it real quick. To calculate declining balance depreciation, the first step is to calculate the straight line depreciation, ignoring any salvage value. So this is how you get it right here. You do straight line depreciation first. And then there are several percentages used with declining balance depreciation: 125%, 150%, or 200%. And then you do this one. And then right here for the next year's depreciation, you will do this ratio right here. Once again, I go over all this in my course. Link down below to join the course. Okay, and I just wanted to show right here, if you look here at figure 13.9, it's showing you the difference. So on the test, they might ask you on year 3 under straight line depreciation or under declining balance depreciation, who had the biggest depreciation. So if you see on the 3rd year, it looks like straight line had a bigger depreciation than 150% of declining balance and 125% of declining balance, because you have to remember straight line has the same amount of depreciation each year. Declining balance has a different rate of depreciation each year. And right here where they were talking about the mark rules right here, the depreciation period called recovery periods specify the time over which you can claim depreciation for that class of asset. And it goes right under here, class lives under Mark's rules. And this is very important. You will probably see this on the test, so make sure to put a tab there or highlight this. You will probably see this on the test. I'm pretty sure I had the question right here for residential real property, including rental manufactured housing. Over what class do you depreciate it over? And it's 27.5 year class right there. And then right here, light trucks is 5 years, office furniture is 7 years. So they'll ask you like, under what class do you depreciate office furniture under the Marks rule? And it's 7-year class right there. Straight line is required for residential and non-residential real estate, but not for most other classes. Very important right there. You can make another important election to expense property placed into service in a year. That means you write off a lump sum instead of taking the deduction over a number of years. To qualify, you have to meet a few rules, and then here's the rules right there. Amortization, that's what I was talking about. Amortization spreads the cost of a major expense over time. Lease or buy benefits if you lease. They might ask you a question like, why is it better to lease than to buy? And the most important thing right here is an immediate tax deduction is available for the cost of monthly leases. So you have an immediate tax deduction if you lease equipment. Read through this, it's super important. Under a lease purchase agreement, the full value of the equipment is included as an asset, and the full liability less equity is listed as payable, both currently and in the long term. Depreciation on the equipment can begin immediately as well. Sales and trade-ins. When equipment is sold, the books have to be cleared of all entries relating to that asset. Super important. The other part of this entry is to book the gain or loss on the asset. These aren't operating gains or losses, and they have to be kept separate from regular sales and gross profit. Otherwise, your comparison of operating results will be distorted. If a piece of $2,500 equipment depreciated to $7,000 is sold for $4,000, the loss in the sale is $3,000. Super important. Learn how to do this as well. I go over this in my course. So that is going to be it for chapter 13. If you have any questions, please put it in the comment section down below, or you can text my WhatsApp number as well. And if you guys want to join the course, the link is down below as well.